The regulatory framework and corporate governance. The regulatory framework for financial reporting establishes the principles, institutions, and standards that govern the preparation and presentation of financial statements. Its primary purpose is to promote transparency, consistency, comparability, reliability, and accountability, thereby enhancing stakeholder confidence in published financial information. A robust regulatory system reduces information asymmetry between management and external users while facilitating efficient capital allocation in global financial markets. The program identifies the regulatory framework as a cornerstone of high-quality financial reporting and corporate accountability. Purpose and objectives of the regulatory system. Financial reporting regulations exist to ensure that financial statements present a faithful representation of an entity's financial performance and financial position. Without common reporting standards, organizations could adopt inconsistent accounting policies, reducing comparability and increasing the risk of misleading information. The principal objectives of the regulatory framework are to enhance the credibility and reliability of financial reporting, protect investors and other stakeholders from misleading disclosures, promote international comparability of financial statements, support efficient capital markets through standardized reporting, encourage transparency, accountability, and ethical financial management. The regulatory framework also provides guidance where accounting standards do not specifically address a transaction, ensuring consistent application of accounting principles and reducing reporting uncertainty. International Financial Reporting Regulatory Bodies. IFRS Foundation. The IFRS Foundation is an independent, non-profit organization responsible for overseeing the global financial reporting system. It provides governance, strategic direction, funding arrangements, and oversight for the standard-setting process while promoting the development of internationally accepted accounting standards. Its mission is to develop a single set of high-quality global reporting standards that improve transparency and accountability in financial markets. International Accounting Standards Board, IASB. The International Accounting Standards Board, IASB, is the principal standard-setting body operating under the IFRS Foundation. It develops and issues IFRS accounting standards, updates existing standards, and maintains the conceptual framework for financial reporting. The IASB aims to ensure that accounting standards produce financial information that is relevant, faithfully represented, and useful for economic decision-making across international jurisdictions. IFRS Advisory Council, IFRS AC. The IFRS Advisory Council provides strategic advice and technical consultation to the IASB and IFRS Foundation trustees. It represents a broad range of stakeholders, including regulators, investors, preparers, academics, and professional accounting bodies. Its role is advisory rather than legislative, helping ensure that standard setting reflects practical business and economic developments. IFRS Interpretations Committee, IFRIC. The IFRS Interpretations Committee, IFRIC, supports consistent application of IFRS accounting standards by issuing authoritative interpretations where ambiguity or diversity in practice exists. It resolves emerging accounting issues that are not explicitly addressed within existing standards, thereby improving international consistency and reducing reporting disputes. International Sustainability Standards Board, ISSB. The International Sustainability Standards Board, ISSB, develops globally consistent sustainability disclosure standards that complement financial reporting. Its objective is to provide investors with decision-useful information regarding sustainability-related risks and opportunities that may affect enterprise value. The integration of sustainability reporting reflects the growing importance of environmental, social, and governance (ESG) factors in modern investment decisions and corporate accountability. Role of IFRS accounting standards. IFRS accounting standards establish the recognition, measurement, presentation, and disclosure requirements for financial transactions and events. Their primary role is to ensure that financial statements are prepared using consistent accounting principles across different entities and jurisdictions. Application of IFRS enhances international comparability of financial statements, transparency of financial performance and position, investor confidence in published information, efficient allocation of capital across global markets, reduced opportunities for accounting manipulation through standardized reporting requirements. Consequently, IFRS facilitates informed economic decisions by investors, lenders, regulators, and other stakeholders while promoting global financial market integration. Corporate governance and financial reporting. Corporate governance refers to the system by which companies are directed, controlled, and held accountable, particularly regarding the stewardship of shareholders' resources. In financial reporting, governance establishes mechanisms that ensure directors prepare financial statements with integrity, transparency, and compliance with applicable accounting standards and legal requirements. Effective governance minimizes agency conflicts between shareholders and management, strengthens internal controls, and enhances confidence in financial reporting through accountability and independent oversight. Duties and responsibilities of directors. Directors bear ultimate responsibility for the preparation and presentation of financial statements. Their key responsibilities include preparing financial statements that provide a true and fair view of the entity's financial position and performance, ensuring compliance with IFRS accounting standards and relevant legislation, selecting and applying appropriate accounting policies consistently, maintaining adequate accounting records and effective internal control systems, safeguarding company assets and preventing fraud and material misstatement, assessing the entity's ability to continue as a going concern and making appropriate disclosures where uncertainty exists, exercising professional judgment and ethical responsibility in financial reporting. Directors therefore act as stewards of shareholders' resources, with corporate governance frameworks and external audits providing additional assurance that financial statements are reliable and suitable.